In our next session, I said we wanted to take a global view. So we've looked at some global GBS trends. Now we're going to have a global economic outlook. And Greg, maybe if I could ask you to come up onto the stage and you can take this session forward.
Thank you, Andrew. And we're going to be in trouble because our session will be fully male, so apologies for that. But before our session, let me just, I'm going to keep it for Chris. Before that, let me just say that it's great to see so many of leaders here today, so good morning. Before we move to the key part of this session, let me just quickly introduce myself. So my name is Grzegorz Goralczyk. I'm also known as Greg, just like Andrew introduced me. I'm the center head and president of the management board for HSBC entity in Kraków. And I just wanted to say a few words about the HSBC itself, okay? If you don't mind, just to make sure that you know what we are doing. So obviously HSBC is one of the world's largest financial services company in the world. So we are founded in 1865. We provide a service in 62 different countries and territories, and we serve over 39 million clients globally. HSBC is also present in Poland. We have corporate bank in Warsaw, but our main office is actually in Kraków, and it's a shared service center. We've got almost 6,500 people working for us in Kraków across different streams, operations, technology, finance, risk, and many more. Considering the current geopolitical situation, together with the Aspire board, we thought that it would be really valuable to provide you an update in terms of what may be coming towards your way in the near future. And hence why I'm pleased to invite on the stage Chris Hare, who's our senior economist from HSBC headquarters in London, who will give us an economic outlook and what we can expect over the next few months.
Thank you very much, Greg, for a very kind introduction, and good morning, everybody. Before opening up for a bit of question and answer, which hopefully we'll have some time for, I want to speak for about 20 minutes or so. And in those 20 minutes, I want to spend some of my time thinking about the economic outlook over the next 20 months. That's the disinflation bit, hopefully. Hopefully we think inflation is gradually coming down, and I'll talk about some of the consequences of that. Then I want to think about challenges to the economy over the next 20 years and beyond. That's the automation bit. But I also want to talk about some other big economic themes like the future of work, the future of cities, which, having sat through the fascinating session earlier on today, hopefully brings out some themes that's really resonant for global business services, which will help inspire some of the discussion through the course of today. So, let me start with that first bit, disinflation. How optimistic can we feel that some of the cost and price pressures we've been facing over the last couple of years is settling down? Well, let me start with some good news. Headline rates of inflation are falling. On the left-hand chart here, you can see the consumer price index measure of inflation for various economies that I'm going to keep bringing up through this presentation. So for the US, the Eurozone, the UK, and Poland. We know that inflation reached the double digits. It is coming down, and it's in the single digits. Now, some of the good news here relates to energy prices, or less bad news, should I say. A lot of this fall in headline rates of inflation reflects the fact that we're not seeing a repeat of the huge ramp up in utility prices that we saw this time last year. Inflation is an annual rate of change, and it just mechanically drops out of the annual calculation. Although later on I'm going to say, actually, there's a little bit more better news in other bits of inflation, when we're thinking about food, when we're thinking about consumer goods. But when we strip out energy prices, and we can also strip out food prices, we can look at the index for core inflation, underlying inflation. And this is something that central bankers are really looking at very closely at the moment. And you can say again, well, there is some good news here. Those core rates of inflation are on the way down, but they haven't fallen all that much. and they're still at rates which are high relative to where central banks would like to see inflation, and I think where a lot of businesses and consumers would like to see inflation too. So there is still a way to go. So looking forward, how optimistic can we be about that extra bit of inflation being squeezed out of the system and turning to a more kind of normal, quote, normal economic environment? Well, there's kind of good news and bad news with regards to the outlook. First, I mentioned the good news, and that mainly relates to energy prices. The left-hand chart shows you wholesale gas prices as they're faced by wholesalers in Europe. And unsurprisingly, you can see those huge rises in gas prices before, during, and after Russia's invasion of Ukraine. But the better news is that those wholesale gas prices have come down very sharply, not back down to pre-invasion levels, but they have come back down and they're now much more settled. Now that Europe, by and large, has weaned itself off the vast majority of Russian gas supply, we think it's actually quite hard to envisage the kind of shocks that will start bringing these gas prices up to anything like the sorts of levels that we saw in 2022. So hopefully we're in a slightly more stable position here. Now, those gas prices and utility bills, they're not going to get back down to 2019 levels anytime soon, but at least the end of that kind of extreme volatility, we think is a situation that we're now in. Also, in terms of food price inflation, things are moving in a better direction. So on the right-hand chart here, you can see indices of agricultural commodities. And again, you can see a Ukraine war impact when you look in particular at vegetable oil, cooking oil prices. And to be fair, some of the trends here have been a little bit more mixed, but we think the direction of travel is better. If you think about food price inflation rates, they were up at 20% plus through much of Europe at their peak, and now they're just about reaching the single digits. So we think there's a better direction of travel going on here. But it's not just about energy and food prices. We also think that a lot of the supply chain disruption that we saw through the pandemic and exacerbated in many ways by the war in Ukraine, that's also easing too. If you look at that huge ramp up that we saw in global shipping cost indices, well, that's basically done. That's on the way back down. And if you look at producer price inflation for goods, essentially this is goods as they leave factory gates, well, those producer price indices have shown a massive fall in inflation. So there's clearly a better direction of travel here. And we think over time that is starting to feed through into a lower rate of growth in the prices of consumer goods. So that's the good news. But where are we more cautious? Now, where we are more cautious is when we're thinking about domestic inflation pressures, particularly with regards to labour markets, labour costs, and wages. And that's the bit of inflation that's left over. And it's potentially going to take some time to essentially be squeezed out of the system. So on the left-hand chart, for example, you can see wage growth in those selected economies. US towards the bottom, currently seeing wage growth of around 4%. Poland at the top, where wage growth is still very much in the double digits. Of course, for those people getting big pay rises, that is a good news story. But of course, at the same time, it is a cost challenge for businesses. So what is driving that wage growth? Well, one of the answers is sort of explained on the right-hand chart. This shows unemployment rates for all those economies. You know as well or better than me in terms of the region that labour markets have been tight. There's a search for talent. Economics 101 tells us that if labour markets are tight, well, that leads to substantial pay rises in order to attract and retain the right sort of talent. And that's something that we've seen. But in Europe in particular, more so than in the US, there's more to it than that. In large parts of Europe, there are wage indexation agreements such that high rates of past inflation often are reflected in pay negotiations and pay deals. That's probably been a part of the wage inflation story in Europe. And there have also been policy changes. For example, in many major European economies, there have been big rises in minimum wages. That's been the case in the UK, it's been the case in Germany, it's also been the case in Poland. So you've got all these confluence of things that are making wage growth very strong. So where do we think that things might go from here? Well, if you kind of squint at the very end of this chart here, unemployment rates have stopped falling, and in some cases they're rising very slightly. Now, rising unemployment in and of itself is not a good news story, but it does also tell us that perhaps labour markets are loosening a little bit. The push for talent will get just that little bit less intense, or competition for workers will get that little bit less intense, and that might see wage growth ease very gradually. And also at the same time, if headline rates of inflation are coming down, well, then companies don't necessarily need to offer the same sort of pay rises in order to address very understandable issues with regards to the cost of living. So it's crystal ball time. Let me get out some economic forecasts. And I always present these with a degree of humility. Economists have not always got it right when they try to forecast inflation. But here are our inflation forecasts for the US, Eurozone, UK, and for Poland. And as I mentioned, of course, you can see that huge hump in inflation, and a good chunk of that has come down. But then look at the forecast. The point I want to make is that the road from here we think is going to be quite slow. I mentioned that better news when it comes to energy prices, when it comes to food prices, when it comes to consumer goods prices. But when we're thinking about those cost pressures in the labour market, which are there, we think that actually takes quite a long time to adjust over time. It will take some time for wage growth to slow, or those labour cost pressures to ease. And it will take some time for then that in turn to lead into softer business costs and softer rate of growth in consumer prices. So even by the end of next year, for example, we're seeing inflation in Europe or in the Eurozone still up at around 3%, Poland more up towards about 4%. And even by the end of 2025, we still see relatively elevated rates of inflation. So it's a long-haul process. The European Central Bank's Isabel Schnabel talked about this being the last mile. And it's potentially going to be a bit of a challenging one, particularly when we think about business cost pressures. So what do policymakers actually do about this? Well, a couple of pictures, which I think has resonated with some central bankers recently, and I'll explain why. When it comes to interest rates and what to do about interest rates, the Bank of England's chief economist, Hugh Pill, said that he favoured what he called a table mountain approach to interest rate setting. It's a sort of situation where you raise interest rates, but then you have to keep them elevated for quite some time so that disinflation feeds through the system, and only then can you start really thinking about cutting those interest rates. He compared that to a Matterhorn approach to interest rates. That's on the right-hand side there, where you get rates up quickly and then you cut them very quickly. So what do we think is the kind of optimal approach? What do we think central bankers will actually do? Well, some more forecasts from me. In terms of our interest rate forecast, we broadly think that central bankers will take a table mountain type approach to interest rates. So we know that interest rates were raised very substantially, starting really Poland in 2021, and then the ECB, Bank of England, Federal Reserve moving a little bit after that. But in terms of the forecast, we sort of subscribe to a higher for longer type view. We know that financial markets have got more excited about the prospects of rate cuts in the near term, but we're a little bit skeptical. I mentioned about that extra bit of inflation having to be squeezed out over a long period of time. So when we're thinking about the first rate cut in the US, for example, we don't think it will happen until the third quarter of next year, the first ECB cut right at the end of next year, the first Bank of England rate cut right at the beginning of 2025. Now, in terms of the National Bank of Poland, even there we think the narrative has changed. Yes, we saw a sharp couple of rate cuts, but in the last policy meeting, a lot of economists were surprised by the fact that the central bank stayed on hold. And I think there's an increasing view here also about that persistence in inflation requiring rates to stay somewhat elevated for a more prolonged period of time. So a return to the very low interest rates that we saw back through much of the noughties is something that we don't see anytime soon. So that's the economy over the next 20 months in terms of interest rates, but are there going to be some strains and stresses along the way in terms of high cost pressures, high borrowing costs? Potentially. If you think about some sectors around the European economy, they are under some stress. So the left-hand chart here shows you bankruptcies or declarations of bankruptcies among certain sectors. But those sectors that are potentially under the most strains are those that already suffered from the consequences of the pandemic in particular. So when we're thinking about accommodation, food services, transport and storage, not necessarily global business services, I would argue, but potentially those are some headwinds to think about, at least for some sectors of the economy. There are potentially some stresses and strains in terms of consumers and households worth watching out for. In the US, for example, we've seen some uptick in consumer credit default rates, and maybe that's another headwind worth watching out. I should say it's only some uptick. From a household balance sheet perspective, we're fairly sanguine about the outlook, not only in the US, but also in Europe, but at least for some households, that is potentially a headwind worth watching out for. And of course, there are other headwinds facing the economy which aren't just related to high interest rates. We also know that world trade, or growth in world trade, as you can see in the left-hand chart there, bar a recent uptake in one particular index we like to look at, has been very weak. There have been headwinds to the global economy, partly related to the property sector in mainland China, and in China, consumer confidence levels are very low. So when we're thinking about a relatively muted pace of growth in demand from China, when we're thinking about European exporters, European industrial production, for example, we think there are headwinds there worth watching out for. On the other hand, though, there's potentially some better news stories. So I talked about headline inflation coming down quite quickly. And when we think about real wages for consumers around Europe, so wages adjusted for inflation, well, they've now more recently returned to growth. And that could be a tailwind to the economy over the next couple of years. Now, there's an open question as when that real wage growth gets back into positive territory, whether those income gains are going to be saved or whether they're going to be spent. Frankly, it's an open question, but we think it's something that can be supportive for the growth outlook. So overall, when we're thinking about the economy over the next 20 months, it's a slow process of disinflation. Some stresses and strains along the way for some businesses around the economy, but potentially some silver linings. If inflation is coming down, well, maybe that's going to ease the cost of living for a lot of households. But what about the next 20 years? What are the really big challenges? Now, I think there's a theme, actually, I can tie between the recent past and the future as we see it. Now, I talked about high inflation, or a large part of high inflation being driven by labor shortages. But labor shortages are something that is potentially here to stay for quite a long time. We're at a demographic transition in Europe, where working age populations, as you can see on the left-hand chart here, are shrinking or potentially about to shrink. And that's likely to be a headwind on what us economists would call labor supply over a prolonged period of time. So I think there are long-term questions in terms of how to meet those potential labor shortages over the decades to come. Now, of course, one of those ways of meeting it is migration. So here's a chart here showing Ukrainian beneficiaries of temporary protection status. Poland, it's 1 million Ukrainians, although in terms of actual Ukrainians who have come to Poland, the numbers are a fair bit higher than that. You know, this is a large inflow of migration, as you will know far better than me from first-hand experience. So there's a challenge here, but a real opportunity potentially in terms of thinking about how to integrate migrants into the labour force more generally. Now, when thinking about integration or metrics of integration, we often find this to be quite a helpful one. It's the Migration Integration Policy Index. It's put together from a set of academic studies, and it essentially tries to assess countries in terms of how successful they've been in terms of integrating migrants through a whole range of different areas, whether it's labour markets, whether it's education systems, and so on and so forth. I should note this is a snapshot taken in 2020. You can see the Nordic economies, at least according to this metric, pretty successful on this front. Poland further down the list, but as I say, this is something that was taken in 2020. It's not necessarily resonant of the conversations I've had with the more recent integration of Ukrainians in its early days in the labour market here. But that's certainly a challenge and an opportunity worth thinking about. A second thing that I think stems also from labour shortages is actually something that springs from some of the discussions that were had earlier on this morning. And it's about technological progress and the use of technological progress. Now, here's another survey here. This one's from the World Economic Forum. This is based on a survey of the share of firms who are thinking about incorporating AI into their processes by 2025. Perhaps unsurprisingly, it's the majority of companies across all sectors in the economy. Perhaps unsurprisingly, the front runners here for financial services, digital communications, and IT. Now, there are people in this room, or most of you in this room, will probably know much more than me about the practical application of AI in terms of global business services. But a couple of points I wanted to make from a macroeconomic perspective, or more questions I want to pose. The first is, will new technology, or AI in particular, make economies more productive? And I would argue that the jury's out. What we see over time is that productivity growth can come in waves, whether it's the Industrial Revolution or the IT boom, which really boosted productivity in the 90s and in the early noughties. Smartphones, however, not so much, we tend to find. One adage from economists is that we see computers everywhere, but not in the economic data. We don't necessarily always see the kind of productivity enhancements from new technologies, at least more recently, that we might otherwise expect. For AI, when I talk to businesses, it sounds really exciting in terms of the productivity gains that can come from there. But I think it remains to be seen whether we're really going to see it in the macroeconomic data and ultimately in the prosperity of nations over time. But there's a couple of more questions I want to ask about AI. One is, are the robots going to take our jobs? Who knows? But over time, we know that technologies come and go. I showed you unemployment rates earlier on. They're very low. Not necessarily. But then there's a third question. Are we going to be able to sit back and watch the machines do the work and work fewer hours ourselves? Well, potentially. And we have seen that over time through economic history. Now, I talked about the next 20 years. Now I'm going to go back, actually, more like 400 years. This is an example from the UK. The left-hand chart shows you average hours worked per week in the UK. And this is something that peaked at over 65 hours a week around the time of the Industrial Revolution. And it's fallen since then, but not by as much as some economists have expected. So on the right-hand side there, that's a picture of John Maynard Keynes, the godfather of macroeconomics. Every economist like me has this guy pinned up on their bedroom, of course. He wrote an essay in the 1930s trying to predict what the economy might look like for his grandchildren. And he suggested that we might get to a world where new technology makes us so productive that we'll only need or only want to work 3 hours a day or 15 hours a week. Well, that hasn't happened, but it's happened to some extent. If you look at UK average working hours, they're about 32 hours a week. So we do move in that sort of direction. But I think ultimately, we often underestimate our capacity to create jobs for ourselves as technology comes along. But I think the big challenges for businesses now is to think about, well, are those new tasks that people undertake in a world of AI going to be productive tasks, or are they going to really move businesses up the value chain? And I'll leave that as an open question, I think. More technological change, or more issues relating to the labour market, and this is something, of course, that was discussed earlier on. It's about hybrid working, facilitated by technological change, and working from home, which we think is potentially an important aspect of talent attraction and retention. Here on the left-hand chart here is another survey from the World Economic Forum. It shows you, broadly speaking, in Europe, the number of working days per week in the office for those sectors that can, in theory, facilitate working from home. In terms of the gap between employers and workers' desires, well, it's somewhere between 2 and 3 days a week in terms of working from the office, and I'm sure you will have your own experiences of that. But again, as an economist, I'll pose similar sorts of questions than I did with AI. Is hybrid working making economies more productive? Is it going to make economies more productive? And I'm afraid, again, I'm going to sort of sit on the fence here. You'll speak to one economist and look at one academic study that says, yes, absolutely, working from home does increase productivity, and others that suggest, no, it doesn't really. So I think the jury's still out, and I think we'll need some more years of economic data to get a decent judgment there. But I think one thing that we have really seen in terms of working from home is the ability to help address labour shortages and match workers to jobs. So on the right-hand chart here, from the same survey, it's a survey here of workers. Is working from home easier or harder in terms of interviewing for other jobs? And, a large number of people say it's easier. Now, I'm sure as employers, a lot of you don't want to think that as your employees are working from home, they're actually secretly interviewing with other people. Okay, that's not the best news aspect of it. But there is a good news story here, and then in that you get the ability to hire from a much broader set of geographical regions, and you're able to include more workers into employment. In the US, for example, we've seen big increases in female participation rates in the labor market through the pandemic, and a lot of the anecdotal evidence is that actually working from home has been a facilitator of that. So from that labor market flexibility perspective, we do see some net benefits from our perspective. But as with any structural change, whether it's technological change, whether it's hybrid working, it's something that we think creates winners and losers. And it's winners and losers that I think I want to finish up with thinking about from an economic geography perspective. Now, I've been in Kraków for all of 12 hours, so I'm hopelessly underqualified to think about how these technological changes might change the economic geography around here. But a word on the UK. Now, this chart here shows you an index put together by the coffee chain Pret or Pret-a-Manger, and it shows you transactions relative to pre-pandemic levels in different kinds of urban areas. And you can see that those urban areas which are relating to working in the office or commuting, when you think about regional train stations, when you think about the City of London, well, transactions are down, still by more than 10%. But if you think about those areas where transactions are up, London airports, well, it's the post-pandemic holiday boom probably having an impact there. But also London, suburban areas, regional towns, we think that's where the shift in economic geography is happening. It's away from commuter-heavy areas. It's away from your central business districts. It's more towards suburbs and more towards smaller towns and cities, which can accommodate a combination of leisure and work. We think that's the economic direction of travel. So I'm going to finish up with my main points. Now, over the next 20 months, things will hopefully be less challenging than they were through the last 20 months. Who knows? There is a process of disinflation that's happening, but we think it's going to be a fairly slow burn thing. And don't get too excited about the prospect of interest rate cuts or very aggressive interest rate cuts anytime soon. And when we think about challenges, labour shortages is one of those things for the near term, but potentially something that's going to be faced by the economy over the next 20 years. Having said that, there are potentially some quite exciting ways in order to meet those challenges. And through the process, well, there are going to be winners and losers. But hopefully, in terms of certain areas of economic geography, there will be winners that we can best make advantage of. I'll leave my comments there, and hopefully there's time for some questions and answers. Thank you.
Thank you, Chris. I think we have time for 2 questions, and I hope you're fine. I'll have first one, if you don't mind, Przemek, okay? So Olaf from PwC was saying on the previous session, Chris, that COVID and conflicts had no impact to GBS. What about strengthening the currency? Would you see that as a potential impact to the GBS industry?
Yeah, I think all else equal, strengthen the currency, it erodes competitiveness to a degree. And if you couple that with high labor cost growth, then you think the kind of cost advantages, might be impacted in some way. But if you think about strength in the currency here, that could be for good news reasons. If you think about increased investor appetite with respect to Poland post-election, potentially. If you think about a stronger currency in response to a view that the central bank is going to be firmer in terms of squeezing out inflation and cost pressures, then actually it's potentially a good news story. And not just that, if over time, in fast-growing economies in the long run, cost advantages wane, I think that's a fact of life. But it's the value advantages that I think are the things to really tackle over the next 20 years.
Hi, Chris. I'm Przemek Roth from Dyson. I have a question regarding the inflation. When I look at the global map of our locations for our business services industry, and when we compare Asia, for example, with Europe, we have certain programs, and I haven't seen that in your presentation, like Fit for 55, European Union introduced, that is going to certainly hit the energy prices. What's your view, actually? How big would be the impact, and how it would actually threaten or not the competitive position of EU-based companies?
This is in terms of energy prices?
Yes.
Yeah. Partly through regulatory change, and also partly through the fact that, particularly when we think about gas and electricity, which is, a function of what's going on in gas prices, and that we have had a very, very persistent, maybe permanent supply shock with Europe making do without Russian gas. So there are all of these things that are creating a confluence which will keep energy prices somewhat high. So I talked about a good news story where lower energy prices mean that energy inflation is falling out. But if we think in the long run about energy costs and utility bills, they're not going to fall through the floor anytime soon. So to the extent that those cost pressures are there in the level, it's only a certain mitigated good news story you can tell. Not the volatility of the last couple of years, but high price levels potentially here to stay.
Andrew, we're done, right? Thank you very much, Chris.